if you are new to this game, you can understand who you need to spend your time with and where you need to direct your energies. My name is Carine Schneider. I'm a managing founding partner of Compass Equity Strategic Advisors. And we are a firm that helps companies with their compensation and equity needs, as well as a number of investment banking, M&A type activities to help companies grow, both here in the United States as well as outside the United States. Joining us today is Tomas Millar. And Tomas, you want to give everyone a little background on yourself?
Yeah, sure. Thank you, Carine. So hello, everyone. My name is Tomas Millar. I'm the CEO and founder of EQVista. What do? We do cap table management. So if you want to issue stocks to yourself as a founder or investors, or develop or create different employee stock option plans, EQVista is the place to go. And on top of that, 3 months ago, we launched neobank Checkly. So we can help you to incorporate a company and then get you a bank account, or technically a Checkly account with a Visa card, and you can issue any payments, or you can send any payments or receive payments. Thank you.
Thanks. And also joining us is Rich Moran. And before Rich introduces himself, I'm going to make a pitch both here and at the end. Rich is so close to getting over 100,000 followers on LinkedIn, and we're hoping that all of you who join in today can follow Rich on LinkedIn to get him over the top and get him over 100,000 followers, because life changes at that point. And Rich will be 30 years younger and millions of dollars richer, but hopefully we can help him with that. But anyways, Rich, why don't you tell everybody about yourself?
Sure. Thanks for the plug about LinkedIn there, Carine. And I am in a hotel lobby, so if there's the Backstreet Boys playing in the background, forgive me here. So I have been in and around Silicon Valley for a long time, most notably for all of you. I was a partner at Venrock, which is one of the major venture capital firms for a long time. And I'm still in the venture capital world, funding companies either based on who I know or based on a small fund that we've created called Tonic Bioventures, which is all about healthcare and treatments for diseases. So I'm happy to be here.
Great. Thanks. And I should say, I mean, between the three of us, we've all raised capital for our own ventures. And I think we're all investors in companies. It's kind of hard in California not to be an angel investor these days. I'm also an advisor to an AI fund, venture capital fund out of Israel. So we all have come from different places, but hopefully you'll find our information helpful. Let me just tell you, kind of set the stage before we jump into some questions. But funding it's currently down. I mean, everywhere you look, the numbers are going down, but what they call dry powder, which is another term for the amount of money that venture capitalists and other investors have to invest, is significantly up. And why that's important for all of you on the phone is to know that the money is there. It's just that the investors are making much more conservative in decisions. They're taking longer to make decisions, and I think everybody is always a little worried about the winter that is coming and making sure that they're prepared. We're seeing especially a decline in seed and early stage funding, and I'm assuming most of you who are on are in that space. And so, when we're looking at numbers, we're looking at slides in the 30% area, the 50% area. What is interesting, I will tell you, and if you go on to TechCrunch, you can read a lot about this, is that the darling right now of the investment community is anything AI related. And when I talk to other investors, venture capital funds, and the fund that I'm advising, AI is a very broad term. That's like saying I'm going to invest in the internet. What does that actually mean? It's very popular right now to invest in those companies, but there really is a difference between companies that are building the infrastructure and the technology around AI, like ChatGPT and companies like that, versus companies that are taking the concept of AI and applying it to different types of sectors. So applying AI in the medical sector, in the retail sector, things like that. One other thing I want to mention before we get into the questions is that, we're certainly seeing investment around the world. And I looked at the list of people who signed up for the webinar, and it is really interesting how many people are from all over the world. And so the idea that you can only come to Silicon Valley and get investment really isn't there. To give you an idea, in Asia, late stage funding is up 50% year over year. And the investors are investing in semiconductor, EVs, and sustainable energy. While in Europe, it's up about 20% late stage funding, and the deals are mostly focused on energy and manufacturing. So it is important to kind of understand how things are going. Now, the last thing I'll just mention before we jump into it is that you have to look at the exits. You have to look at the IPO market to understand where venture capital and angels are, because they recycle their funds. So in order to invest in a new company, they need to have an exit, and a successful exit, from a company they've been investing in for 5 or 8 or 10 years. And the IPO market has pretty much been dead for the last 18 months until we saw last month Instacart and Klaviyo both go public. The IPOs were priced a little higher than they had expected, but both firms are not, probably Instacart is not doing as well as Klaviyo. But these are the things, the indicators that these investors are looking at, is what's happening at the exits. And so what you're seeing is a very robust private equity world, and a lot of M&As, a lot of acquisitions, because companies can't go public. So all of this is important to understand. And then you layer on that higher interest rates, so people can put their money somewhere safer and get a nice return on their money, and they may put less money into a risky place like venture or angel. All of that is why you're feeling perhaps some headwinds and you're feeling some pain. So let me start, maybe, Rich, if I can ask you, can you just make sure everybody understands the difference between an angel and a venture capitalist, and perhaps a private equity firm, so that people kind of know the different types of investors to talk to?
Sure. Warning, Carine has asked me to be blunt and direct on this, so I will try to be blunt as I can be. Yeah. So number one, my advice to everybody on the call is that if you don't need venture capital money, don't take it. If you don't need investors, don't take them. So a couple things about that. One is regarding venture capital. What a lot of people don't know is you give up 20% of your company right from the start, and that can be whatever stage you're in. There's going to be dilution. You're going to give up a big chunk of your company. You may not want to do that. That's with traditional venture capitalists. On the angel front, those can be very helpful. What you might be dealing with, though, is 100 dentists who all have $100,000 left over from their taxes from last year, and that can be, that can create all kinds of problems with your cap table. It can create all kinds of problems with getting calls at midnight about where'd my money go. So just know that that's part of it, but both can be great routes. The private equity deal, the private equity firms are not usually interested in building companies. They're interested in selling companies. So unless you have a legitimate, real company that you think should be part of a roll-up or part of a sale or part of an M&A, I would stay away from the private equity firms. And all of this sounds pretty negative maybe, and I didn't mean it to be that way, because the venture capitalists especially can be really helpful in building your company. And as lots of venture capitalists say, it's not hard to build a $5 million company, but it's really hard to build a $50 million company. And that's what a venture capitalist can do.
Thanks, Rich. Yeah, and Tomas, I mean, you're right in the middle of it right now. You're raising funds. Tell us a little bit about your experience dealing with different types of people. And maybe I should just confer, just make sure everyone knows. An angel tends to be someone who's on their own. They have their own money, So they are investing their own money, not a firm's money. They haven't raised money from other people. They tend to be people kind of retired or folks who have made their money elsewhere. So it's a very different experience than working with a venture capital firm where you have individuals who are going to come and help you with your company and deal with things in a very different way.
Yeah, of course, Carine. Thank you. So if I may also divide the angel group a little bit. So there are also two types of venture groups: the ones which can invest, who can invest heavily. They usually write larger checks. They can practically fill out the whole investment round. So let's say $5, $6, $7, $10, $15 million. They usually go after deep tech companies, and then you have angel investors with smaller checks up to $100,000, $200,000. That's the usual. That's the usual size. So yeah, we are fundraising right now $7.5 million. The whole thing is that we practically bootstrapped and then self-financed all of our companies. So we have to catch on all the due diligence materials, which we finally did. And now we are practically talking to several investors. Yeah, I must admit that the climate is really tough, but I think that once this winter comes down, then I believe that there will be a gold rush on startups. Because, Carine, as you mentioned earlier, there's lots of dry powder, and it must go somewhere, right? Like investors just can't be sitting on money and just wait, right? They can obviously get 2-3% of management fees. They usually get that percentage to cover the daily operation, but they have to invest somewhere. So I'm expecting and hope I hope that once this miserable time will go away, especially for startups, then there will be gold rush on startups. Yeah. Hopefully, it might come back early next year. It really depends on many circumstances. But during the dark time, people usually forget that there's a light at the end of the tunnel, and vice versa. During the happy times, the dark moment come also.
Carine, if I can just add something also, because I believe there's a misconception about funding, and especially outside of Silicon Valley, people believe that there's a line, sort of like at the delicatessen, you take a number and you get in line, you get funded on 3000 Sand Hill Road. That is not the case. There's money. One of the best deals I ever funded was the founder I met in a parking lot while we were waiting for our valet cars to be brought to us. So there are sources of funding all over the place. It's not just in Silicon Valley, and it's not just in the big firms where you send a deck and nothing ever happens. Yeah. One last thing, my experience on the decks also is people, if you send in a pitch deck for an investment, somebody looks at it. It may not be the person that you want, it may not be the partner in charge, but somebody in general will look at that proposition.
Yeah, and I want to get to decks in just a moment. I would say too, family offices are another place to look, and family offices tend to be very focused, very sector focused. So they may be, in a certain area of medical or healthcare. They may be in energy or sustainability or something like that. So it helps to do some research in terms of who might be interested. And again, just to make sure people understand, a venture capital firm goes out and raises money for a fund. That fund generally has to be deployed and hopefully repaid within 10 years. So if you're a year or two into the fund and it's right now, you got to, like Tomas said, you got a little bit of time to maybe wait and be choosy and be picky. But at some point, that money has to be put to work, or you're never going to raise another fund, because the people who invested in your fund, who are called LPs or limited partners, those people are not happy that they just handed over money to you, especially in high interest rate time, and you're doing absolutely nothing with their money other than, as Tomas said, charging them fees. So the